Good afternoon. This is Chris Robinson, Ag Marketing, with today's post-close grain and livestock comments for Monday the 8th. Well, a lot going on. We got a USDA tomorrow at 11 o'clock. Um, President Trump's promised $12 billion coming to farmers soon. He also hinted that China may buy more soybeans. I think we've been down this road before. We'll have to wait and see when the buying shows up. Net on the day, March soybeans down a penny, 443 and 3/4 on a 5 cent trading range. March beans down a dime, actually down 10 and a quarter at 11.05 and 3/4. Jam beans, spot beans, um, well below $11, settled at 10.93 and 3/4, down 11 and a half. New crop soybeans, wasn't that long ago we were at 11.31. We are now at $11. The biggest loss, correction wise, we had jam beans trade on 11.69. So to be at 10.93, that's a big chunk. If you follow my letter, you know that we've given back half of that $1.57 rally. It's a reset button, bullish or bearish, whatever your opinion is. You've got a reset button here heading into the USDA report tomorrow. That's the way I look at it. Chicago wheat, both, and KC wheat both slipping lower, both down a penny. KC was down 4 3/4. If you get my letter, you know I pointed out the fact that we're on a trend line here. We're dancing with potential new contract lows if this fails. Now, historically, the December USDA report is not a big deal, but everything's kind of gone out of the window because of when the government was shut down. Obviously, the biggest report price-wise that represents price risk. And again, I don't care what your opinion is. If you're bullish or bearish, that January report represents risk. We're here to manage risk. I'm not here to call lows or call highs or anything like that. I can't stress that enough. I work with end users who don't like higher prices. I work with farmers who live and die for higher prices, right? So my job is to manage risk. There's always somebody out there that will tell you what you want to hear. They'll tell you the USDA is this. They'll tell you the funds are that. They'll tell you that, whatever story you want to hear for them to, have you like them, or maybe you want to do business with them. I just try and give you my best opinion, and I try and give you my best hedges on how to manage your risk and let the chips fall where they may. Bean oil was lower today, down 50 cents. Soybean meal down, on the day, DC meal was down just over a penny, down 1.1. Let me see where we settled there, DC meal. But again, what's going on in DC meal? We've had that tremendous rally. We've given back a pretty good percentage pullback. Meal had been up at multi-month highs. If you go back to where we were on the middle of November, right? That's the highest price we've had since February. So you're looking at a 10-month high. Now we've given back how much? Half of the rally, and the rally which was from September to November. So a big correction. Markets like to do halfway backs. It gives everybody a chance to be right and be wrong. I'm not anticipating anything tomorrow. I don't know. We could have a no-brainer, a nothing burger report tomorrow. We could have something where we move. Anybody who tells you they know where it's going, I would take it all with a grain of salt. I would just say keep your risk on paper. The nice thing is, like I said, you can do options for 4 days, 11 days, 18 days, and defend your risk. In the protein complex, fat cattle finished down $1 in April, down 220, settled at 226.70. We didn't get any follow-through buying, kids. We had a 50% retracement there on Friday. We weren't able to take out Friday's high. Are we done rallying? I don't know. We'll probably see what happens tomorrow with the USDA, with corn price, if corn price move at all. Feeder cattle down $3 on the day. Again, we couldn't get into the gap in March. Everybody's looking at those gaps. Everybody's looking at the same thing. Can March feeder cattle ever make a run back up to the top of the gap, which is at 345? It would be really nice considering we're trading at 330. Everybody would like to get that $15 back. The fact remains, kids, we just rallied $40 in 8 days. We went from 293 to 333. That was a tremendous recovery after just getting a gut punch, liver punch, heart punch, whatever you want to call it, when the cattle corrected, right? And nobody knows when the corrections are going to come. I understand that, but you don't have to bite off more than you're chewing when you're hedging. There's some strategies out there. People always come at me saying, "Oh, it's easy to look back and say, look, you shoulda, woulda, coulda." Absolutely not. I mean, there's a approach to hedging. The bottom line is, it does cost some time and some money to do it. Nobody sells the top. But what I try to do, is I want to get to the meat of the move. So we rallied $1.10. We're going to get every penny of it. No, but a good hedge can help you take the meat of it, so you don't get hung out to dry when the market loses half of its value. What took 10 months, we gave back half of it in 5 weeks. That's the type of stuff we try to avoid by hedging. Now, are we going to turn around and rally higher? I don't know. I hope we do, but there's a hedge for that as well. If you're selling your animals here and you're mad and you think that it's going to go higher, well, a hedge is not always a put. You can hedge after the sale with a call. Sometimes that's the best strategy. So it is an evolving trade. It's an evolving risk management program. And again, I'm focused on farmers and producers. You're always long if you're a farmer or producer, right? So of course, the hedge that we're going to be looking at the most is a put, because a put protects you when prices collapse. So people always say, "Oh, you're what we're talking about is puts, puts, puts." I'm like, absolutely not. If you sell your product and you want to reown it, absolutely positively look at calls. And to finish up in the lean hogs, they did manage out a 20 cent higher day, but pretty much sideways trade there as well. If you look at that correction that we had in the hogs as well, we went from contract highs to 5 month lows. Then we spiked back. How much did we spike back? About 38%. Are we going to go back up to 88 or 90 in the April hogs? I sure do hope so. But hope is not a marketing plan. So we try and manage risk the best we can. We don't have a crystal ball. We don't have ESP. We don't have any knowledge that anybody else has. What we try and do is manage risk, get the risk on paper, and we know tomorrow. Hopefully nothing happens on this report, right? Hopefully nothing bad happens. But if you're worried about that, whatever bad means for you, get a hedge on. Okay, this is Chris Robinson. Thanks for your time. Give me a call, 312-638-8868. Have a good night.